Hey everyone, once again, welcome back to our Financing Simplified podcast. If you haven't checked out our last podcast with Nick Stillo from OneUrban, we encourage you to do that. Very interesting conversation. We're going to shift gears right now. I'm going to throw it back over to you, Nick. Give us a little insight, introduce yourself once again to our viewers.
Yeah, thanks for having me on your show again. So my name is Nick Stillo. I'm the Chief Operating Officer and one of the principals of OneUrban. OneUrban is a multidisciplinary real estate company that is in the development business, in the building business, in the property management business, and we're soon to open up different divisions of our company. I can't say too much about it just yet, but we are slowly becoming or vertically integrated, rather.
That's amazing news. And as I said, love the conversation with you. We always have good conversations on and off the camera. And I think one of the major conversations right now, especially when it comes to builders and developing, is the current cost of the financing right now. Obviously, the affordable housing, we were talking about several components earlier on. And I wanted to get your insight on maybe the up and coming areas, things that maybe we should be paying attention to. We're talking about multifamily homes. Multifamily units are going to be, I believe, the next big thing. If they already aren't, they're already the biggest thing. We've been seeing a lot of conferences on that. What are some of your thoughts on that?
So in terms of geographical areas here in Ontario, I think up and coming markets are Niagara Falls. I think that Windsor is an up-and-coming market. Both of them have very, very strong rents. Both of them have very, dare I say, affordable lands still. Properties in the GTA are so expensive now that really it's almost impossible to do purpose-built rentals. You almost have to sell them, and you have to sell those properties for $1,500 plus a square foot to ever make your money back. But in these tertiary markets like Windsor and Niagara Falls, and frankly, I wouldn't even call them tertiary. I would call them secondary markets because they're really not in the outskirts. They're still accessible from Metrolinx and GO trains. These markets are really up and coming, and there's a lot of opportunity there, and they're still not that built out just yet. There's still a lot of opportunity for builders to go in there, and even just your average investor to go in there and start scooping up some multifamily properties in these areas, because as the areas become more gentrified and built up, now you've got an opportunity where the rents are going to start to go up, and it creates a little bit more of a lucrative investment.
You said gentrified. We were talking about this, and I really love this concept in the sense that you can take an area or go into an area that was previously maybe one level or one set of criteria, let's say, for the sake of
not as desirable, maybe
not as desirable. That's probably the word I was looking for. And then you can go in there and really, change the direction or the course of what that area will look like. We were talking about Soho, and you're also, talking about these costs with, getting those rents, having to sell these units as we bring in higher and higher levels of immigration. Where are we putting these people right now? Like, from your perspective, because I know you guys as developers and builders, you must have these conversations and sort of say, well, where do we go from here? How do we get more inventory? How do we get more product into the marketplace?
Well, first off, you're putting them in the sky, so you are using airspace. Condos are not going to go anywhere. High-rise purpose-built rental buildings are not going anywhere. In fact, it's the only place that we can put them. We recently heard that the provincial government now took back the green belt, so now that's a ton of housing that was promised to come to market, which is not going to come to market. Unfortunately, the province of Ontario is a very, very big province, and there's a lot of green space that can be built on. But the unfortunate part is that we just can't build on that. So where do you build? You build in the sky. So that's the first thing. Second thing is you start looking at these outside markets, which weren't previously as desirable as the GTA. Again, like the Niagara Falls area, like the Windsor area, like London, like Chatham. There's like Port Colborne out in the east. There's a lot of areas that are still accessible to the GTA or people working in the GTA, but it'll just a bit further out. And there's an opportunity for developers to go in there and gentrify. And gentrification is, as you mentioned earlier, it's taking an area that was previously a little bit less desirable and now putting new product in there and putting a new vibe of living in these areas, and people are attracted to them again.
Mm-hmm. And I love how you're saying on the outskirts and stuff like that. Now, there's a lot of conversation happening. I think Calgary's done this. They went through a major change with a lot of their commercial units. I don't know if you're aware or familiar with the concept, but obviously, what do you think like would take as a developer? Would you ever consider taking a commercial building and unzoning it or rezoning it to maybe fit multi-families or condos or units?
Absolutely. In fact, you're seeing a lot of REITs doing that now in the city of Toronto, where they're taking a lot of empty office space and they are rezoning it for residential and converting them to residential. So what were previously high-rise office buildings, which are now, quite frankly, empty after the pandemic, where a lot of companies realized they didn't need 5 floors of offices in prime downtown location, and now they've reduced that to 1 floor, if that, and the majority of their employees are working from home remotely. Mm-hmm. These building owners and property owners are now rethinking their strategy of how do we make money on this now. If the businesses aren't coming back, if the offices are not coming back and people aren't renting anymore, how do we convert these now and make money on them? So what they're doing is converting them into housing. So absolutely, I would look at opportunities like that. Now, personally, I like to take nothing and turn it into something. So I like buying land. I like putting it through the development process. I like seeing the birth of a brand new building. But I'm not closed to the idea of buying an asset and converting it into a multifamily asset.
So I actually 100% agree. You're saying that, and for those of you paying attention or watching, if you were to buy something in those tertiary or secondary markets, you're going to pay a lot less. And the rents are not that far off from where you're getting in Toronto. So you're almost better off looking into these secondary markets. They're more profitable for up-and-coming developers, real estate investors that are looking. And this begs the question, because we get a lot of calls and a lot of questions about this, and they say, Anth, real estate investing, it's dead. It's dead in Ontario. What are your thoughts on that?
False. Can I mention another podcast on here?
Absolutely.
So some guys out there, Daniel Foch and Nick Hill, who have a fantastic podcast on real estate on their own, talking to these guys, and they've got multifamily units out in the secondary markets that are cash flowing. Find me a investment in the city of Toronto that's cash flowing today.
There's probably not many.
There's none. Unless you've owned it for a long time and you've been able to realize on that equity
and you haven't
increase
refinanced or releveraged it.
You haven't, then you're cash flowing. But if you're buying today, you are not cash flowing. Period. But these guys are cash flowing out in Angus. These guys are cash flowing out in Port Colborne. These guys are cash flowing in in Peterborough. But most investors want to stick to the city of Toronto because it's Toronto, and I get it. There's a line from the very, very first episode of House of Cards that I'll never forget, where he says, the main character, Francis says, Underwood, he says, well, the power is like real estate. The closer you are to the center, the more expensive and pricey it is. And I get it, okay? The more closer you are to the city of Toronto, the more closer you are to financial district, the closer you are to entertainment district, the more valuable that real estate is. But what value does it have if you're pumping so much money into that unit every month just to keep it going?
Investors they say on some of these new projects are making up almost 30% of your sales.
If not more.
What problems, like in this day and age, like most people buy these units, like I believe OneUrban was what, a couple, like the from launch, you said was a couple years, right? From pre-sale to close, how long was it?
3 years.
3 years. Okay. So in that 3-year period, let's say I bought it 3 years ago, right? Obviously it's closed, different market, but let's say, what are some of the things that you could see happening right now with higher interest rates? People aren't qualifying. What actually happens? Like for viewers that don't understand, like they may think, oh, the builder is the end user of the condo unit. They can just absorb these units. How does it work? For you as a developer, you can't can you close on this unit if you have existing units outstanding? How does it work?
So you certainly register the building. You can only close the units that the purchaser is able to get financing on. On the ones where they're not able to get financing, you can't close. Now, as a builder, you do have the right to keep their deposit, which is written in the agreement of purchase and sale. So it's not something that's illegal. In fact, It's the only way that the builder can try to recoup some of that revenue. And then what a lot of builders will do on unclosed units is they'll take an inventory finance, and they will finance those units that have not closed. Maybe they'll put a tenant in there to try to carry the cost. They'll use some of the deposits to try to carry the cost. But at the end of the day, they're out. They're out of those funds. I'll put it to you this way. If I was building condos today, I would be very scared in this market. I would be extremely scared when you've got 7% interest rates, and a lot of people are I'm seeing assignment sales through the roof. And some guys and investors are walking away from deals, and they're taking a loss. They're walking away and they're taking $100,000 loss, and they've already paid the deposit on it. They just know they're not going to qualify, so they want to just get out with something. If I was that developer, I would be very, very scared. Because imagine you've got a 200-unit building, and now half of them don't close. You've got 100 units. Even if you finance that and get an inventory financing, you still got to carry those payments. Even if you put a tenant in there, you still got to carry those payments. It might not cover those payments. So now you're out of pocket. You've got to continue making those payments until they sell. And in a market like this where stuff isn't selling, good luck.
And does this, like as you said, it is scary, and that's sort of the down you're tugging that line where I wanted to sort of bring this conversation, because I think for a lot of people the question is even if that inventory does end up spilling back into the market, is it going to move the needle? Number one. Number two is, as you mentioned, these assignment sales, they should be changing. Do you think they should be changing some of these rules? Like, obviously, as a builder perspective, I'm going to put my builder hat on, and nowhere close to, I'm not a builder, but if I'm looking at this now moving forward, as we've gone through an environmental change, right? The market's shifted. If I'm a builder now of a condo and I see John Smith comes in and goes, I want to buy 10 units, and
I'm not selling it to him.
Right?
But that was the case even 3-4 years ago. We had several investors come in and wanting to buy multiple units, and we were advised by our legal team not to sell it to them because of the fear of closing.
Like, unless they can provide you with like proof that they have the liquid assets to close on these units. But even that, as I said, it's a waiting game where I think what's happened over the last little while is really, and hopefully it actually wakes a lot of people up to say, like, listen, because we've heard stories all the time of investors that are trying to assign their units, and it's near to impossible. Not only from the financing perspective, it's like very difficult.
Well, from a legal perspective, a lot of lawyers don't even understand assignments.
No, they don't. They don't understand what the causes are, what's being paid, who's paying for what. It's just a nightmare, and that's a big factor that I think is going to actually. Do you think that's above all the things we talked about in this episode and the previous episode about the financing, the cost, and everything? Is that not another fear that we're adding to the pot to say, look, I'm a condo developer. This is why maybe a lot of projects aren't going to market right now?
Well, a lot of projects aren't going to market because most construction financing is a floating rate. So it's not. It's basically your prime rate plus whatever the financier wants to add for their basis points. So let's use this current environment as an example. If you started building as a builder in 2021, when financing rates were still low, and you've got a 3-year construction cycle that doesn't end until mid-2024, you've gone through 10 hikes. Every time there's a hike, it changes the amount of interest that's owed on that project. The financier has the right to turn the tap off, which basically means we don't fund next month's draw until you put, as a developer, in the difference. So if the difference on that interest on a $100 million project on a 25 basis point increase is, it's $2.5 million. The developer has to come in and put that $2.5 million. If that happens 10 times and they don't have the money, then that project goes into receivership, and the financier pulls out their finances out of that development. They pull their cash out. They call the loan. It's a very scary environment. Like I said, if I was building condos right now, I'd be very scared.
So this just brings us a little bit round full circle. It's like, how can we hear the conversation as everyone, sort of harks on builders. And I'm like, it's not the environment right now to take on that risk, especially for the end user, as opposed to, is there the same amount of risk when it comes to a purpose-built rental? Would you say it's a little bit, a lot different?
There is and there isn't. The risk is that you put up the covenants to build the building, because no one's going to come out and give you $100 million to build a product unless you've got the covenants to be able to back it up. So first off, you put up the covenants, and then you build the project. So you've put all the money up, you're paying the interest on the project, and you don't have guaranteed sales like you do on a condo. Now you have to hope that old saying, build it and they'll come, comes true. That once you build it and you start marketing it, you have to hope that you're going to get renters. Now, in this market and in the environment that we're in, where there is low inventory of rental units at pretty well everywhere, the risk is a little bit mitigated, but there's still a huge risk. So at the end of the day, you're paying that interest until the entire building is full.
Absolutely. But at the end of the day, you're going to have potential renters in the in your units paying you revenues on those units. The question is, what happens? As I said, right now we're in an environment where rent seems to be going up, right? And you're building your unit at today's costs. What happens down the road? Let's say if we start to get more units and the rent changes, does that change the dynamics of your project? How does it change the dynamics of your project?
Well, if the rent changes, if it goes up, it obviously makes it better. If they bring in rent control again, then it'll make it worse. And what I'm hearing a lot of people talk about rent control again, where the Ford government removed rent control a few years back. Anything built after 2019 was not subject to rent control. With all this talk about non-affordability, it's a very high probability that they might bring that back. That certainly changes the numbers for certain developers. But let's keep in mind that when developers are forecasting their building, they're using today's rents on a product that won't come out for another 3 years. So you hope that with your annualized increases that you will be able to have better numbers, but you can only do your numbers based on today's rents. Where that gets a little tricky is that you're also using today's construction costs. And construction costs are going up rapidly. Like just 2 years ago during the pandemic, the construction costs went up 30%. So if you budgeted $300 a square foot, now that building ended up costing you $390. That's $90 a square foot more that it cost you. That could seriously impact your debt service coverage, which would require you as a sponsor, as a building owner, to now put in the extra cash required into that deal to increase your capital in that project. Otherwise, the financier might say, well, you're not covering your ratios anymore with the amount of cash you have in the deal. We're going to pull our money out.
Especially with the code here, do you think Ontario's, actually, just to go back to that for a second, because there's a lot of controversy around, like, Ontario's code is probably, would you say our building code is one of the best, or do you think there's a lot more room for improvement from your perspective?
No, I think it's fine. I think that it's been evolutionized over the last number of years, where it's been built on and improved. The last national building code was released in 2017, and the previous one was 2015, and I think it's just getting better and better as building and construction goes on. But frankly, I mean, I hear a lot of people say, "Oh, houses aren't built like they were in the 50s." And I actually had an online debate with somebody that,
thank God,
that was very, very asinine comments that was coming from this individual that absolutely had no idea. And they said, look at all these houses that were built with brick and they're still standing, and now they build them with wood. And I said, well, but so were those houses. Those houses were, the substrate behind that brick was built with wood, and they put brick on top of that. That's how construction works. And the houses that are built now are actually way more efficient than they were built back then. And to your point, thank God, they're much better built unit, much more efficient, much more energy efficient. And you are getting better housing today than you were many years ago. What you are getting less of is unique design. You're seeing a lot more cookie cutter, and that's just a way for developers to make the costs work, because you have to. You can't make a subdivision that has 1,000 homes with 1,000 different designs. You just can't. You need to be able to create a certain number of home types and different elevations that they can then plan in that neighborhood to have different looks of houses. But yes, you are going to drive down 10 streets and see 10 of the same home on each one of those streets.
Yeah, builders are just trying to put them like maybe sporadically.
No, that's right. They space them out so it doesn't look as cookie cutter.
That's why they give you these elevation options, right?
That's right.
A, B, and C. It's absolutely incredible to actually think about it from the perspective of having to build that home from the 50s to now. Yes, obviously the cost and everything associated to it. But yeah, I believe we are building better quality homes. But there has been some arguments put forward, is like, as the cost for material comes up, and as I said, with builders right now these days, especially these condos, we start to hear a lot of people that have issues, right? These condos, like major issues with the reserve funds because there's cracks and foundational leaks and stuff like that. Is that a result of poor craftsmanship, or maybe a builder trying to cut corners, or a mixture of both?
I don't think it's either, because all the concrete in a building is tested, and it's tested for its strength of its cure date, which is 28 days after it was poured. So it's got to pass a strength test that is dictated from the Ontario Building Code. Properties shift, foundations shift, they settle, the cracks happen. You talk about reserves, that has nothing to do with the developer and everything to do with the property manager that's in the building managing that property after the condo developer has already pulled out of the development. So, I've heard of buildings that have fantastic reserves where every time that there's a problem, bang, it's fixed right away and you get no problems. And then I've heard of buildings that are completely mismanaged that have no reserves, and then they go to all the residents and say, well, you've got to put up $50,000 per unit, otherwise we're putting a lien on your unit because it needs to be fixed. Things happen. Here, I'll explain it to you this way. You have an iPhone. Mm-hmm. That iPhone, whatever it is, your iPhone 15, that iPhone 15 was tested by 1,000 people before they ever sold a single unit. Mm. Every condo is built like a prototype for the first time. It's built once. It's never tested. The first people that test it are the first residents that move in. Mm-hmm. So you're going to get leaks. You're going to get cracks. You're going to get shifting. It's inevitable. Even if you have the exact same design team working on two different projects, you're never going to get the same trades. And even if you get the same trades, contractors, you might not get the actual individual trade workers that are building it. So you might have the exact same contractors and the exact same design teams working on two different projects, but now the men working on that site are different.
Nick, honestly, it was great to have you. The quality, the content, to have someone of your stature with the amount of knowledge when it comes to building and developing to share with our viewers to understand exactly what's going on. I really appreciate it. Thank you for having on once again. Nick, where can they find you?
OneUrban.ca. You can find us on our website. You can find us on social media, Instagram, Facebook, all the cool places that you can find us. So
if you're looking for an upcoming project, check it out. And you can find us obviously on our website at In Touch Mortgage Solutions, on Instagram at @A_Venuto, or at In Touch Mortgages, and YouTube, Spotify, all the channels for those podcasts. Once again, thanks for watching. We'll see you next week.
Thank you.